One of the concepts often mentioned in financial markets, but not fully understood by many investors, is the concept of a market maker. When translated, this term generally means a participant that makes the market. Market makers are important players who help ensure that trading in financial markets happens smoothly and continuously. So what exactly does a market maker do? In financial markets, every transaction requires two sides, a buyer and a seller. However, there may not always be a buyer and a seller available at the same time. This is where the role of market makers becomes important. Market makers continuously provide both buy and sell prices, allowing trades to happen without interruption. For example, when an investor wants to sell a stock, there may not be an immediate buyer in the market. If a market maker is present, that institution or participant can buy the stock, allowing the transaction to take place. Likewise, when an investor wants to buy an asset, the market maker can provide the selling side of the trade and supply liquidity to the market. Because of this role, market makers are often seen as important participants that increase market liquidity. Market makers are usually large financial institutions, banks, or brokerage firms. These institutions constantly quote both bid and ask prices, making it easier for participants to trade in the market. The small difference between these two prices is known as the spread, and it is one of the main ways market makers generate profit. For example, the bid price of an asset may be $100, while the ask price may be $100.10. The difference between these two prices is called the spread. Market makers can earn profit from this difference while facilitating trades in the market. The presence of market makers is extremely important for financial markets. In markets with low liquidity, trading can become difficult, and price movements may become much more volatile. Thanks to market makers, buying and selling can happen continuously, and price formation becomes more stable and efficient. However, market makers sometimes become the subject of debate. Some investors believe that market makers influence the market or manipulate prices. Especially during rapid price movements, some traders may assume that market makers are responsible for these moves. In reality, the primary role of market makers is not to manipulate the market, but to ensure that trading can take place smoothly. They act as a bridge between buyers and sellers and help transactions happen more efficiently. For this reason, the market maker system is actively used in many financial markets. In stock markets, foreign exchange markets, and even cryptocurrency markets, market makers play a crucial role in maintaining liquidity. Experienced investors understand that analyzing markets is not only about looking at price movements. It is also about understanding how the market itself works. Because behind every price movement, there are often different mechanisms operating in the background. Market makers are one of those mechanisms. For this reason, understanding the concept of a market maker is very important for anyone who wants to better understand financial markets. Because behind many of the trades we see in the market, there may be invisible participants who help keep the market functioning. And those participants are often market makers.